It was another tough day on Wall Street with the S&P 500 down over 1%, the VIX going back up to 26, and we even had enough selling on the Dow Jones Industrial Average to have another oversold cluster signal. We didn't have very many stocks closing in the green today, had a smattering of them in the healthcare and financial world, but most stocks within utilities, REITs, and energy closed lower almost across the board. So it was definitely an ugly day in certain patches of the market. In tonight's video, I spend quite a long time talking about some of the past bear markets like 2001 and 2002 time period to give you a sense of how long bear markets typically last. We also have a good conversation about the VIX and where we're at today in comparison to other important levels throughout history. And then in tonight's trade application example, I get into a sold put idea on the only debt-free dividend aristocrat company out there. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's September 15th, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into our description area. Make sure you're signed up for our email distribution list so that way you can be notified anytime we post these videos. You'll also find at the bottom of those emails which stocks are giving you overbought and oversold cluster signals. I imagine there's going to be quite a few oversold cluster signals here after the selling that we encountered here yet again today. Also, quick heads up, David will be out of town here for the next few days, and so there probably won't be any market outlook video. I'm assuming he's not going to do it while he's on the road, and so that's important for you to be signed up for our email distribution list, because otherwise you might be left wondering whether the video is going to get done or not. By just checking your email, you'll know whether the video was done. So hopefully most of you have done that already, but always a friendly reminder just to double check just in case you haven't. In addition to that, we're heavy users of Twitter. My handle is @BrandonVanZ. We'd really appreciate those of you that click like and retweet on these market outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's jump into today's trade activity. And as you can see, I've got the S&P 500 heat map in front of us. And once again, it was a pretty difficult day. A lot more red out there than green. Of course, this follows the intense sell-off that we experienced on Tuesday, where it was an avalanche of selling. Some of you might have seen my tweet later that night. Unfortunately, Comcast had knocked out my internet for the entire day. Go figure, of all days, the day when the market is just collapsing. So that's my little grumble for the moment, but hopefully not offensive to any of you who are maybe Comcast employees. I know they kind of get a bad rap for their reputation, and now I understand why. But later that night, I finally got internet connection once again, and I took a screenshot of the heat map on Tuesday to post to Twitter, and mentioned that there were only 5 stocks in the entire S&P 500 that closed in the green. So 99% of stocks were lower. Today's not nearly as bad as what that was on Tuesday there, but nonetheless, still a lot more than half of the stocks did close lower here today. In terms of any major patterns I'm seeing here, I would say that the financials appeared to hold up maybe a little bit better. I see a bit of green there. If I were to kind of click into the financials, you'll see some of our big banks held up reasonably well today. JP Morgan up 1.5%. Bank of America up 1.89%. Wells Fargo up almost 2% there. So that certainly helped a bit. I also noticed that, I think it was healthcare. Yeah, healthcare had some patches of green in there. If we zoom into healthcare here, you can see Humana had a great day. It was up 8% here today. Considering the fact that the S&P 500 was down over 1%, that is saying something. But they weren't alone. You also had United Healthcare up 2.5%. There's Bristol Myers Squibb. That's one that we have a sold put on in my Monday afternoon class right now. It's up nearly 2% today, along with Elevance and CVS and Cigna and AbbVie. Had some nice green there in the healthcare realm as well. But otherwise, it was pretty hard to find. I mean, you've got, a few one-off situations. I did notice the casinos were up today. Remember, it was a week ago when I was last doing the video with you where I was excited about my Rams, and boy, oh boy, did they let me down last Thursday night as a game. And congrats to those of you who are Bills fans. The better team certainly won that night. Nonetheless, I am happy to report that my trade application example that I presented to you to kind of fit the theme of NFL football kicking off, DraftKings, actually has done quite well over the last week. One of the few stocks that's actually higher week over week, despite the huge sell-off in the market here recently. But DraftKings wasn't alone today. You also had the more traditional casino operators doing quite well today. You can see Las Vegas Sands was up 4%, and then where's Wynn? Is this one Wynn? Yeah, Wynn was up 7% today, the second best performer in the entire S&P 500 after Humana. And so a little bit of buzz there in the casino space, whether it's the online operators like DraftKings or whether it's more of your traditional brick and mortar casinos like your Las Vegas Sands and MGM and the like. Other than that, not a whole lot to get excited about out there. It does seem like we had a lot more obvious kind of trends in the bearish camp. So let's talk about technology. Let me zoom in here. And you'll see it was a pretty awful day for technology. Of course, Apple and Microsoft demand our attention given their market caps being well over $1 billion and $2 billion. Trillion. Boy, it's kind of hard to even spit that out. It's so massive. But yes, these days, Apple is a $2.4 trillion company, Microsoft $1.8 trillion. So remember, the S&P 500 is a market cap weighted index, meaning that Apple and Microsoft are basically the most important components of the S&P 500. So when they are down, chances are higher than not that the S&P 500 will be down, and that's exactly what we saw today. But this was not a situation where they were alone. They certainly had lots of help pushing the market down. In fact, the worst performer in the market today is this little square down here, or rectangle down here. That is Adobe, and that was almost a 17% sell-off today for Adobe, as they came out and announced an acquisition where maybe the market is telling them that they're paying too much for the merchandise. We actually had a secondary conversation about a different software company in my question and answer session earlier today that suffered the same fate a couple of weeks ago when they announced their own acquisition. So it doesn't seem like this is a market that is willing to be overly forgiving around acquisitions if you are the acquiring company and you are paying nosebleed prices and really high valuations and premiums and things like that. So Adobe was part of the story as to why the market really could not get it together today. It's hard to overcome a 17% meltdown in a very important company. This might not look like that big of a deal to those of you watching the video because you look at Adobe and you say, well, geez, that's kind of a nothing stock compared to Apple and Microsoft, but don't let it fool you. This is a $144 billion market cap. This is not the Adobe of 20 years ago. This is a behemoth of a company these days. So, compared to other non-tech companies, this would be one of the bigger mega cap companies out there. And it just lost 17% of value with the snap of the fingers. In terms of other areas, I would also point out utilities seem to struggle today. We did focus on the utilities at the beginning of my question and answer session today to make up for my missed DGI class on Tuesday because of my Comcast outage. So we made up for it and did our traditional head-to-head matchup by buying a dividend growth investing stock in the utility space today, a rare day where they finally sold off, which we appreciated. REITs also joined utilities in that sell-off. You can see the vast majority, if not all, of the REITs were down here today. Yeah, it looks like it was a clean sweep to the downside there. Now, one REIT that you don't see here because it's not big enough to be in the S&P 500, but is one REIT that we actually covered almost exactly 3 months ago in my dividend growth investing class, Store Capital. Some of you that are dividend growth investors will recognize that name. It's ticker symbol STOR. That was one of the few bright spots within the market today. Again, it's not big enough to be in the S&P 500, but speaking about buyouts, they did get a buyout offer of their own, and that particular REIT was up 20%. So they bucked the trend of the sector at large because of their buyout offer. But again, because they're a little bit of a smaller REIT, they're not going to show up in this graphic since they're not in the S&P 500. And then I also wanted to show you energy because it wasn't just utilities and tech and REITs that struggled. Energy was down pretty aggressively here today as well. A clean sweep to the downside, not a single energy component in the S&P 500 managing to close in the positive territory. So, all in said, it was a tough day. You had a few bright patches there with the banks and a few of the healthcare companies, the casinos, but that's just not enough to overwhelm the selling of Adobe and Apple and Microsoft and Alphabet and Amazon and all the utilities and REITs and energy companies. It was still a really heavy feeling day. The other thing I might add is that I'm delivering this presentation here in the after hours session on Thursday, and I wish I had better news for you, but right now the futures are down again after hours because we just found out that FedEx reported their earnings, and boy, oh boy, did they swing and miss. Stock is getting crushed after hours. It's down like 15% here as we speak. So remember, that's not going to show up here because this heat map is only showing us what happened in the normal session. And as you can see, FedEx was basically flat in the normal session, down just a skosh, but it is down 15% after hours, and that's sending the likes of UPS and a lot of the other transport stocks down lower as well. So unfortunately, unless something changes overnight, you might want to brace yourself for more selling tomorrow. And remember, tomorrow's an important day. Tomorrow is options expiration for the month of September. So those of you that are options traders, make sure you're babysitting your positions out there. We even had to roll one of the sold put contracts with the, I think it was Scott's Miracle-Gro. And otherwise it looks like it's going to close in the money. So remember, because this has been a difficult selling period, some of the stocks that you sold puts on might be closing in the money, and you have to make that determination. Do you actually want to accept ownership of that underlying business, or are you going to look to roll your contracts to a following month and strike price? So just a friendly reminder that tomorrow's your last chance to kind of babysit your September positions and make sure you go into the weekend with everything squared away there. All right, let's go ahead and pop on over here to the main part of the platform. Take a look at our breadth measures. And as you can see, I've got the S&P 500 pulled up here in the index watch, and there were 142 out of 500 stocks closing higher today. So that means that was approximately 28%, I believe, of the market. So close to a division of 1/4 versus 3/4, with 1/4 of the market effectively closing higher and 3/4 of the market closing lower. And that seemed to be about the case when I kind of eyeballed it on the heat map there a moment ago. It seems like those numbers jive in my head. So again, another way to tell, today was certainly no victory type of a day. We have not really gathered ourselves up after that massive sell-off on Tuesday, which was the worst day for the stock market in a couple of years, a true disaster there. So today didn't help. We'll see what tomorrow brings, but with it being options expiration, people trying to reposition themselves, and it kind of gives you the feeling like people are a little bit off sides in this market. They're not positioned the right way, given the fact that we had 4 days in a row to the upside before the selling took place. Let's go ahead and take a look here over at our charts. And I wanted to show you this chart 6D. Remember, I like to show you guys this chart when we have at least a 1% move in either direction. And boy, we've had a few of those lately, haven't we? Here is what it looks like after today, where we've got the red line stretching down and below this blue horizontal line telling us that this was a 1% down day. Remember, you can read the little labels there to help remind you of what the different colors mean. Tuesday, as you can see, we stretched down below this fuchsia horizontal line, and that was more than a 3% day. In fact, we don't have a 4% line on here because it happens so rarely, but had we had a different color for the 4% line, it would have even gone through that. So that was certainly an oddball day that you don't see all that often. Today was a day with a 1% move that you do see quite a bit more regularly, but I will remind you of something that I was sharing with you guys here a month or so ago. Remember when I would come into these presentations and I would say, boy, it's sure strange we haven't had a lot of 1% down days anymore. And the reason that was coming up in the conversation is because you guys know that on the days when the market's down 1% or more, I like to bring a sold put trade idea to you. It's kind of been my go-to trade strategy this year. I was kind of feeling left out, quite frankly, during this period right here that I'm kind of circling with my mouse, basically stretching from the beginning of July into the middle part of August, where we had very few 1% down days, and it just so happened that the few days where we did get it, David was the one doing the video that day, I was not. And so we went like a month without doing any sold put trades. Fast forward to where we're at now. Now you'll notice that a lot of my trades lately have been those sold puts, and it will be another one of those examples here later tonight in the video. But it's just a reminder that we went through a very quiet period here for about a month, and now it seems like the wheels are starting to come off again, and we're getting more into these really down-stretching red lines like we did back here in the May and June time period again. So kind of, you know, I hate to be the bearer of bad news, but brace yourself. And some of you are bearish, so you're probably loving this type of market environment. I'm not so much because, of course, I am on the longer term side of the equation traditionally, and therefore I just have to sit here and suffer watching my stocks go lower that had been doing so well for years, now starting to topple over. And that is part of the long-term experience, I'm afraid to say. You can't be a long-term investor to hold stocks for years and years and years and expect that they won't ever come down. So this is one of those years where it's tough. In fact, I was just mentioning that on Twitter here a moment ago, saying that I bet there's a lot of people that started 2022 thinking to themselves that long-term investing is easy. And if you fast forward to the end of 2022, I bet those very people will now express how difficult it is to the point where they're probably willing to give up. And that just happens in a very short amount of time of 1 year in the grand scheme of things. So I'm not saying that's good, bad, or otherwise. I always encourage people to seek out the best strategy for their personality. And the truth be told, some people's personality just does not fit well with a long-term mindset because they want to be more active. And maybe they don't have the patience required to hold through these difficult times like this, and they should listen to their gut, right? Because it's part of their personality, and that's why we have such a wide variety of education here at Market Scholars, where we do teach 8 different trading rooms, everything from short-term swing trading to long-term buy and hold investing, with the hope that there will be a class or two that can impact those of you who are trying to enhance your education even further. And I would say that this particular presentation here, the free video that we do on YouTube, known as the Market Outlook video, does cater to the more short-term oriented active trader out there as well. And so I think it does allow us to kind of absorb these market blows a little bit better. It's still not fun, I'm sure of that, but because we do have plenty of bearish trades going right now in addition to bullish trades, it's been a little bit easier to digest the sell-off days that we've experienced here recently. So something to consider there. Anyway, the other thing I should mention while we're on this chart right now is that naturally the VIX did go up today. This purple line down below is the pathway of the VIX, and you can kind of read in the label there that the VIX closed at 26 here today. Now, that's still not considered extreme, right? We still haven't seen a breakout of the VIX above 40 or anything along those lines. Like if I were to kind of show you the pathway of the VIX, let me just pull up a more basic chart, chart 3A here, and pull up VIX. and show you where we are right now. This doesn't scream to you like the market is extremely concerned the way that you might expect after watching the markets melt down for their worst one-day sell-off in 2 years the other day, right? We're still trading on the VIX well below where we were just 3 months ago. And to put this into further perspective, let's go on a... let me see what a max looks like. I'm not sure what it's going to look like. It might not do what I want it to do. Yeah, it kind of gets scrunched a little bit because there's almost too much time there. But the point I wanted to make is that where we're at on the VIX right now is not particularly high. Give me a second here. I'm going to see if I can get this S&P 500 off of here, and that might make it look a little bit better. It's still tough because the chart is being skewed by this really random date over here that suggests that the VIX was up to 172 in that sell-off in 1987, the Black Monday event where the market was down over 20%. The apparent VIX at that time would have gone to 172. But let me do this. I'm going to change it to a 20-year chart. So that way we don't include 1987. And that way we can see these candles a little bit better here. And you'll notice that where we're at right now, at 26, I'm kind of circling with my mouse off to the right-hand side here. Notice how that is not considered particularly high. Notice that we've had plenty of other times, even in recent history, where the VIX was a lot higher than where it's at right now. Earlier this year, as a matter of fact, this candle right here, the VIX got to a high of 38.94. So in other words, basically 39. It did not quite break into 40, but that was just this year. That was in the first week of January of this year. The VIX nearly cracked 40, which is kind of crazy to think about where we're at right now in comparison, because to a lot of people, the markets feel a lot more precarious right now than they did at the beginning of this year. And then if we want to take that conversation back a little bit further in time, most of you were probably trading during the COVID crisis, and you'll see that the VIX spiked all the way up here to, it was 85 at its high. Isn't that crazy? That was only 2 years ago, how easily we forget. And it's not alone. You see this type of thing happen every so often, maybe every couple of years or so. Here we got the VIX going up to 36. Here we got the VIX going up here to 49. This was just in 2018. Here we had the VIX in 2015 go up to 53. Back here in 2011, we basically had 3 straight months where the VIX was up there at 40 or above at some stretch. In 2010, we had the VIX go all the way up here to 48. That was on the mini flash crash day there in May of 2010. And then, of course, I think we all understand that the VIX was dramatically higher in the worst part of the great financial crisis in late 2008 and into 2009. The VIX basically lived above 40, right? It got as high as nearly 90 at that point. But for month after month after month, for like 6 months, the VIX was above 40 on, pretty much a daily basis. Imagine that for a second right now. Like, if people are freaking out right now with the VIX at 26, imagine what it would be like if the VIX was at 40 right now and it stayed there until March of next year. People are having a hard time just dealing with it right now for a day or a week or what have you. But that was an extremely stressful situation back there in 2008 and 2009. That's why, I've heard David harping with you guys in the various presentations and on Twitter and what have you, trying to stress that what we went through here earlier this year was not an actual bear market, at least in comparison to what we went through more legitimately as a bear market in 2008 and 2009. Those are like night and day comparisons there. And it's not to say that a bear market is not over the hill, so to speak. In other words, on the horizon, coming up, right? David's whole point of saying that what we experienced earlier this year when the market was down 20% was not a bear market is not to infer that a bear market is not going to happen. It's to say that you shouldn't consider what happened there a bear market, especially if what is on the horizon is a 40% meltdown or a 50% meltdown. And I don't know that to be a fact either. But the point is, we were at an extremely elevated level stock market wise going into this year. And so when you have a 20% pullback here, it's kind of interesting when I pull up the S&P 500, because when you had that 20% pullback from high to low on the S&P 500, this is what it looks like on a 20-year monthly chart. Now, I'm just doing this by coincidence because I was looking at the 20-year monthly on the VIX. I didn't do this on purpose, but I think it kind of proves the point that I was just making, which is this looks like a pretty gradual pullback here to a rising moving average. This doesn't look like a massive meltdown that would be identified as a bear market, right? You go back here to 2008 and 2009, clearly there was a massive breakdown below the falling moving average there. Today, we're just basically on a support level, if you think about it from that perspective. So it's been an interesting year to educate yourself. Be careful of who you listen to too closely. Not to say that there's not a lot of good voices out there, but I think David was spot on with his commentary that he was making in regards to that particular conversation there regarding whether it was a bear market or not, right? And if we start breaking down below where we're at right now in a big way, then yeah, that will be a bear market. But a lot of people are saying, okay, we're done with the bear market now, when the stock market rallied here in August all the way up to 432 or wherever it was on the S&P 500, saying, okay, now we're bouncing out of our bear market. And David's point was, we haven't even entered it yet, let alone bouncing out of it. So if you think that was a bear market, brace yourself. There could be something truly vicious on the horizon if we have anything that looks even remotely close to what we saw in 08-09. And I'm hopeful that it won't get that bad, because that was hopefully a generational type of meltdown that was somewhat equivalent to what folks went through in the 1930s. But it doesn't mean that it's going to be a walk in the park. It can still be really, really difficult moving forward. So as I always say in this presentation, your job is to survive, because if you don't survive any upcoming bear market, you're not going to be there to take advantage of the future bull market. Because if there's anything that the markets do teach us from a long-term perspective, now that I pull up an all-time chart here, and let's use SPX and as opposed to SPY. Remember, SPY is an ETF that tracks the S&P 500, and it hasn't been around all that long, just since the 90s. But if you pull up SPX, which is the actual index of the S&P 500, it can go all the way back to the 1920s in this case. And part of the reason you can barely even see the 1930s is because we've got these technical indicators on here kind of blocking it. But the other reason is because history blows past all previous bear markets. And it might feel to you in real time like this will never end, the selling will never end, and it's just you feel despair and hopelessness and all this kind of stuff. But history does suggest it will get better. You might have to suffer more pain in the ultimate short term, but over the true long term, it will get better, and there will be another all-time high again. Maybe it takes 5 years to get there, but there will in all likelihood be another all-time high. And if we know that in advance, knowing history as we do here with the stock market, then your greatest crime is not to lose money right now, right? These are tough conditions. We all struggle here and there. Your greatest crime will be to give up because you blew yourself up. Because if you give up when you blow yourself up and you're not around to take advantage of an eventual bull market, you will end up living to regret that in the future. So that's why it's important to tread more cautiously. Some of you might have been playing a little bit fast and loose, and maybe you've learned a few lessons, and maybe that's good for you, right? I always like to remind folks that when I first started in the stock market, it was in January of 2000. That would have been approximately, let me get my mouse on it. Where was it? It's hard to do because we're really in here. Let me actually do this. I'm gonna zoom in a little bit more so I can see it a little bit better. But it was right here, right there. I got involved in the stock market. I was actually prepared to get into the stock market in late 1999, but I was a mere college student at that time, and I didn't know as much as I should have, and I decided I should wait until after Y2K. For those of you that are young enough, you might not even know what in the heck I'm referencing when I say that, but for those of you that are my age or older, you'll definitely remember the hoopla that was going around about the supposed Y2K bug and how it was going to destroy all the computer systems out out there and our whole economy was going to collapse. We look back at that now and we laugh. But at the time, it was being taken somewhat seriously because computer programs up until that point really weren't equipped to change to a 4-digit year because they just didn't really think in advance. But anyway, we got through that without much of a problem. And I decided to start my journey as an investor in January of 2000. And I decided, you know what, this is a pretty good gig because you can see for the next 5 or 6 months, the market just kept on drifting higher. I thought, boy, this is pretty easy. Probably the way that a lot of people went into 2022 thinking to themselves, boy, this investing thing is pretty easy. Well, I came to find out the hard way that it's not easy. There's a reason why the Warren Buffetts of the world are so rare. The people that have the true ability to have longevity in the market and benefit from the market's upward rise over time by being able to survive the most difficult conditions out there. A lot of people just aren't built to do that because of emotions. That's all it comes down to. I think they understand the math behind the situation, but it's their emotions that traditionally get in the way. So after, having the market go up for a good 5 or 6 months after I got into the market myself, then we started the actual slide of the dot-com bubble. And that lasted quite a long time. This probably doesn't do it justice when you're looking at it, but I can tell you when you're living through it, it feels like it's never going to end. When we look at this chart right here, I'll once again kind of show you where we started breaking down. It looks like the highest month close would have been August of 2000. And then we started this 3-month sell-off right here in the autumn of 2000, and we didn't know it at the time, but that was the top, right? We look back in history and understand that was the top during that moment. And for the next few years, all the market did was slide and slide and slide. Now notice you had a few up months along the way, right? You were up here in April of 2001 and then May of 2001, but then that was followed up with 4 months of selling. You know how heartbreaking that is when you're finally thinking to yourself after 2 months, the market's finally getting it together, and then boom, it just goes away, right? It's kind of feeling like what we're dealing with today, because I think a lot of people started feeling a little bit better about the market in July, right? Markets had a good month of July, and even the first half of August was good. And then to see this vicious selling here as we head into September has been quite disheartening. These are months that we're looking at back here. And then we had another situation similar where we had 3 monthly candles to the upside here in late 2001, and then boom, rolling over yet again. You can see how this can really wear and tear at your psyche and your soul and everything else, because we're not just talking days, we're not just talking weeks, we're talking months bleeding into years. Finally, the market gathered itself up here in basically March of 2003, and then we had our big move from 2003 into 2007 before we started that journey all over again. So, I guess my point is what we experienced in the COVID crisis. And I know David and I both spent a lot of time talking about this because it was important to us at that time. But let me pull up just a 5-year weekly chart right now. And we wanted to spend a lot of time during the COVID wipeout making sure people were aware that what we experienced with that V-shaped recovery was not normal. And one of the greatest crimes is somebody who just started trading before that thinking that was normal, and then that was all the pain that you needed to suffer when we went into bearish market conditions. Now, price-wise, we did a fair bit of suffering. Those were difficult times. I remember, my kid was out of school because, of course, a lot of the schools didn't allow the kids to go into the schools because of the COVID breakout. And so I'm sitting at home with my kid, spending time with him, keeping an eye on the market, and we're talking about like 7, 8, 9, 10% down days. Those were terrible days and they felt awful. So we certainly took our licks from a price perspective when we were down 35% in basically a straight line. That was not normal, but either was the recovery to all-time highs by August of that year. Normally, markets, when they have bearish market conditions, are a little bit closer in alignment to what we saw in 2000 to 2003, where it feels like death by 1,000 paper cuts, right? It just aggravating. The market let us off the hook quite easily. And part of it was because the Fed was quite stimulative. And we now know that that has led to the inflation that we now have to kind of pay the piper for today. So you can, look back and be the armchair quarterback and say, well, they should have done this, that, or the other thing. But the truth is, they did bail us out in a hurry, and it felt good during that time to have that recovery. But it is also true that they probably stayed loose with their monetary policy a little bit longer than they should have as well. So that's neither here nor there. But point being, what we experienced in 2020 was abnormal. That is not a normal recovery. What we went through in 2000 to 2003 was a little bit more in alignment with what the coming expectations are if we are to get into a bearish market condition again. So that's your public service announcement of the day. Brace yourself. Markets are not easy. If trading and investing were easy, we'd all be mega billionaires owning our own Caribbean islands. It is a challenge, and a lot of it is psychological, a lot of it is emotional, but it is a challenge nonetheless. And if you're not educated and you don't know what to expect moving forward, it makes it all that much worse, right? And so that's why we spend the time that we do, hopefully talking through these concepts with you, of course, both here and even more so with our 10 weekly classes that we teach at Market Scholars, helping prepare you accordingly, making sure you're ready with whatever the market throws your way, even though you know that you'll never be perfect and there'll still be difficult days in front of you. Hopefully you are better equipped with us than without us, right? That's our hope there. All right, let's go ahead with those dreary comments and get back into our normal flow of our charting. And let's take a look here at what's been going on with our 4 grid. Now remember, the last time I was with you, which was 1 week ago on Thursday, we had just gotten that oversold cluster signal. Let me right click and zoom in on the S&P 500 to hear a little bit more. And so 1 week ago was this candle, and I was talking about how this was a nice little recovery that we've had in the last 2 days. And the thing that I really liked about it was that it happened when I assumed it would happen, which is right after plotting an oversold cluster signal. Remember, that was the only cluster signal that we had had for a few months at that point. So it was somewhat rare, and it basically meant, hey, the selling from here down to here got a little too extreme. Chances of a reversion to the mean move was quite high, and therefore this was a good start to that journey. But you also heard me say that what I'll be watching out for, because I'm still skeptical about any market advance, and I'm going to make the assumption that we will not have a trend changing advance. What I was curious about on this day is how the markets would react when we got to the 30-day moving average. And if they failed at the 30-day moving average, then that would be quite a bearish sign where you might start loading up with bearish trades or loosening up on your more bullish trades. Well, little did I know that it worked out basically perfectly from a charting perspective. In other words, we got the oversold cluster signal, we got our reversion to the mean move, we got up to the falling 30-day moving average, and it rejected it like clockwork. So technically speaking, boy, that worked out pretty much the way I was envisioning it. But here's the problem. From a practical perspective, you couldn't really take advantage of it because of the peculiar nature of this specific day. And what I mean there is, yes, we can recognize that the 30-day moving average rejected this index the way that you might have assumed that it would. But the problem is, unless you were anticipating that in advance the day before the inflation reading, you didn't really get a good chance to take advantage of it, because by the next morning you had a gap down. And of course, a lot of people hesitate, like a deer in the headlights, myself included, when you have a major gap down and you're kind of waiting to see if it will fill that gap a little bit, maybe to put on a bearish trade, and then it just continues to crater lower and lower and lower and basically close near the lows of the session. So this kind of has the feel to me of a market that has left a lot of people frustrated. Bulls and bears alike. And the reason is because even those that would have been willing to get bearish probably wouldn't have been able to put on the positions they wanted to because of how it unfolded with a gap down and a continuation move immediately thereafter. So that's what has made this market feel to me a bit more uncomfortable here all of a sudden this week. In fact, for whatever reason, I'm not sure why, but I have felt a little bit more uncomfortable this week than I did even in kind of that June time period when the markets were even lower than where they were right now. This has felt this week a little bit more like what happened during the COVID wipeout time period. So anyway, if you're feeling that way as well, be aware that you're not alone. And I hope it's just noise, and I hope it will pass. But I also have to acknowledge that after you stare at the markets as long as people do, year after year, decade after decade, sometimes you do get a little bit of a gut feel for things. And right now, gut doesn't feel too good. And some of you heard me mention earlier that David is going to be on a little vacation. He's not going too far. It's going to be a little bit of a road trip to spell his appetite for college football. So we wish him a good journey. But many of you know that our inside joke around here is that when David takes time off, the markets get quite bearish. And so let's hope it doesn't come through that way this time around. But who knows? It would be kind of interesting if we saw the market torpedo lower tomorrow when David is out of town. You've been warned, right? David's on vacation. Let's brace ourselves for the worst possible outcome here. Anyway, things don't look so good, right? Things don't feel good. Things don't look good. And it happened so quickly that it feels like a lot of people have just been left stunned by the activity here this week. And you can see that with today's close, we actually closed slightly lower than where we closed on this day of the cluster. Now, on an intraday basis, I think it was a little bit lower on the cluster day because there it was 38.86. Today's low was 38.88. So on an intraday basis, notice that both of these two candles have these lower wicks or shadows on them, telling you that those were kind of the lowest levels on an intraday basis. But it's the lower right-hand corner in these red filled-in candles where the market actually closed. And on this day where we got that oversold cluster on the S&P 500, it closed that day at 39.08. Today it closed at 39.01, so 7 points lower on this close. That's not a great look either, right? Because it's basically showing you that the market's willing to take out support. And then given the news that I just shared with you a moment ago about FedEx being down 15% after hours, the S&P 500 is trading lower as well. You don't really get the feel of that so much on the index because it's a cash index that doesn't trade after hours. But if you were to pull up SPY, notice up here that we closed at 390 on the SPY. And I know this is going to be hard for those of you watching on a phone especially, so I'll just read it off for you that the bid and the ask right now are both in the 387 zone. So it's below 388 right now, meaning that we are more than $2 lower than the close. And remember, today was a $4 down day, which equated to over 1%. So if we're down an extra $2 per share after hours right now, that means we're down another 0.5% before we even open up trading tomorrow. So that doesn't really give you the warm and fuzzy feelings here as you go to bed tonight either, knowing that tomorrow's an important day for options and triple witching and all that kind of good stuff that'll be taking place tomorrow. We've got ourselves a broken support level. We've got ourselves a futures market that is, starting to crumble. It's a little bit of a strong word there, so it's not really crumbling, but it is moving lower somewhat aggressively for just being a couple of hours removed from the normal market session. Another way to kind of think about this is the low that I mentioned before, the intraday low on SPY on that day of the cluster was 388.42. So right now, in real time, we are trading below the low of that. So right now we know that today's close was lower than that day's close, although the intraday low was a little bit lower on this one. But where we're at after hours, now you would be taking out that intraday low right there as well. And who knows where we end up next, right? You probably have some, support levels here, maybe at around, like, let's call it 373 or thereabouts on the S&P 500. But there could be some more damage done in the short term. Remember, we are in a seasonally difficult time of year as well. So that adds even more concern to the market, right? When we're in September and October, months known for sell-off and for crashes and things like that, that doesn't make you feel any better either. Now, obviously, once we get beyond October into November, December, and January, then we'll kind of flip that a little bit, and there'll be more maybe bullishness from a seasonality perspective. And you never want to trade completely on seasonality anyway, because every year is a little bit different. Nonetheless, you start adding up all these little things, and it goes to show that things are quite, bearish right now, right? It's not a bear market, but the conditions are bearish as we speak. It seems like this is a market that wants to sell first and ask questions later. So brace yourself. These have been difficult times, and we might very well continue to have some of those moving forward. No surprise here that we do have a strongly bearish posture on the S&P 500. That's been the case, with the exception of a day or two here in the middle, for really since the end of August, right? We went to a bearish posture here on August 24th, and we've stayed in this red zone here basically that entire time, with the exception of just the response to that 4-day rally there, but quickly reverted back to where it felt more comfortable. So stuck with a strongly bearish posture at this moment, according to the intermediate line on the market forecast technical indicator. And that's largely the case with these other indices as well. You'll notice here that we've got strongly bearish posture there on the Dow, strongly bearish posture there on the NASDAQ Composite, and now a strongly bearish posture on the Russell 2000 as well. So clean sweep for bearish postures according to that intermediate line. In terms of the percentage moves today, the Dow held up a little bit better, probably because of JP Morgan and a few of those that I had mentioned before. They have a bigger impact on the Dow. So it was only down a 0.56% today. So they actually were the day's winner. The Russell 2000 was only down 0.72% today, so also a relative leader compared to the S&P 500, but it was the NASDAQ that suffered the most. It was down 1.43% today, and again, probably because of what happened there with Adobe. That was a meltdown for Adobe here today, and that kind of translated across a lot more of those tech-oriented companies that are on the NASDAQ right there. So all of our charts continue to have red 30-day moving averages as well, telling us that prices below falling moving averages, which is a bearish feature within the market as well. One other thing that I'll point out before we move on, we did get a follow-up oversold cluster signal on the Dow Jones Industrial Average today. Now, what made the other one different here last week on Tuesday, and why I wanted to emphasize that one so much for you guys when I did the video that night, was that was a unique day where all four of our charts had a cluster at the same time. So it kind of makes it a little bit more interesting than just a one-off cluster by the Dow when you're not really getting the support by the others. It could very well bounce here for all I know. You know, there's been intense selling again, and that's going to have to relieve itself somehow. But I'm not sure I'm willing to bank on an immediate reversal here as much as I would have been a little bit more comfortable with it on this one that appeared last week. So it's there, and I thought I would point it out because it exists, but I can understand where you might not be in the mood, so to speak, to take a bullish trade based upon that lone cluster there in that particular case. Let's step away to the internet here briefly. I always like to say thank you to folks that help support this presentation. This again was the video that I did on Thursday when I did the bullish trade on DraftKings there. And 103 of you stepped up to the plate and clicked like for me there. As I always say, as long as we're up and over 100 likes, I'm happy to do a full-length video, which is where we're at right now. In fact, I'm getting a little lengthy here at 46 minutes in already. Of course, the video would already be done if we were under 100 likes, but I thought it was important to share my thoughts about the dot-com implosion earlier, where the VIX is in relationship to where the VIX has been traditionally throughout history, and some of these other additional talking points here tonight, because I think it's relevant. And so these are some of the extras that you would get as long as you're willing to help support these videos and do a very simple thing that doesn't cost you a single penny. Just click like for us there on Twitter. Thank you to the 103 of you that did that the last time around, and I'll make the same deal with you for next time. If you want me to do a full-length video on Tuesday when I'm next scheduled to do it, click like for me there. As long as we're up and over 100, I'll be happy to do that. All right, let's also have a little chat here about the sector selector and the factor selector tools, since I wasn't able to be with you on Tuesday. So the sector selector tool was updated last Friday, so I'm sure we'll have some movement when I redo this again tomorrow night, but at least can give us a heads up as to where the markets were thinking about going into the week. And what's interesting about it is the markets were actually leaning more defensive getting into the week. Remember, this was produced on September 9th, way before the carnage that took place on Tuesday. But our heads up from the sector selector was already telling you that money was drifting into the more defensive areas of the market, like utilities and consumer staples, and kind of pushing away some of the more cyclical areas like energy and materials down below. Took a little bit of a tumble there as well. So I find that to be a little bit fascinating. Now remember, this is not a perfect tool and it's not going to be right all of the time, but it seemed like this week it was kind of trying to nudge you in the right direction, anticipating that the markets could very well be more bearish this week. And if you're trying to hide out on the long side of the market, you might be a little bit better served in something like the utilities area that I had mentioned before, that we concentrated a lot of conversation on in my Q&A class today. Let's talk about the factor selector. Now this gets updated on Tuesday night into Wednesday morning. So that's what makes this one a little bit different. Remember, I do the sector selector in anticipation of my Monday morning trend trading class. I do the factor selector in anticipation of my Wednesday morning swing trading class. So what makes these two different is that this did have the benefit of including the data from the huge sell-off day on Tuesday. And so it should not be a surprise that when the markets melt down, that low volatility will look good in comparison to everything else. Now, it's also true that low volatility stocks went down that day. They just went down a lot less than what you find with the more cyclical areas. Low volatility is going to include things like utilities, big cap pharma, your consumer staples types of companies, maybe some REITs. Basically, the boring corners of the market are the ones that are maintaining some semblance of strength at a greater level than the more cyclical and speculative and aggressive areas of the market. With energy taking a little bit of a tumble right there from the number 1 position down to number 3 on the sector selector, it wasn't a huge shock to see value fall week over week as well, because a lot of energy companies make up the value factor these days, along with a lot of banks and financials as well. So anyway, this is kind of giving us the same heads up that low volatility is kind of playing into the same theme as defensive sectors. They're both telling us that this is a market that you should continue to tread carefully with, right? Express some caution with it, because it's not as healthy as what some people on CNBC might want you to believe, right? And I'll leave it at that. All right, let's go ahead and pop back on over here now to the main platform and do some 12 grid analysis. And we'll get started here with chart 5A. And so this is our asset class 12 grid, where we look at a lot of different things, not just stocks, and try to sense where money is rotating towards. And unfortunately, the areas that are picking up steam and having some semblance of bullishness are the areas that are at odds with the market at this moment in time, the stock market. And that is down in your lower right-hand corner. The 10-year Treasury yield just keeps on motoring higher. I mean, it's kind of astonishing what we're dealing with right now. The 10-year is at 3.45%. Now that is high, and I was talking in my Q&A class earlier today how we're back to our highs of where we were back in June, just like that, right? We remember at the lows of this move over here in the pre-market session. I remember looking at the 10-year Treasury; it was actually below 2.5%. So we went from basically 3.5% down to 2.5%, 100 basis point move in a month and a half, only to see that completely unwound a month and a half later, and we're right back to where we started. And remember, that is a bugaboo of this market right now. Stocks do not like to see higher rates for obvious reasons. And so when they keep on marching higher and higher and higher, it's no surprise that the stock market still is in more bearish types of conditions right now. So, the other thing that was interesting about the rate conversation is that this is the 10-year yield here, but the 3-month and the 6-month and the 1-year Treasury yields are astonishingly high. They're basically up there near 4% right now. And so there is an alternative in this market, right? For years and years and years, it didn't make any sense going into treasuries because you really didn't get much in return for that. But today there's a legitimate conversation going on, and this isn't the first time I've said this, so hopefully, I don't sound too much like a broken record, but it's important for you to understand that concept, because when market participants understand that there is an alternative to the stock market, they might very well take the market up on that. And therefore, if money is being pulled out of stocks because they now find treasury yields attractive enough, then that's going to pressure stock prices further, right? You need more buyers than sellers, but if people are selling stocks to go into treasuries because they're really attracted to those high yields, then all of a sudden we've got ourselves a little bit of a problem. Now, typically when interest rates go up, bond prices go down. And that was true to a degree today. TLT was down, but very small amount. It was only down 0.06%. In fact, I am pleasantly surprised, given what I know right now, with what's going on with my sold put trade on TLT. Remember, I did that as a sold put trade application example in this video a few weeks ago. And you'll notice TLT really hasn't gone up, right? It's continued to kind of slide lower, but that trade has actually been quite profitable. So really what we needed with that particular trade was not necessarily for TLT to go up. It just needed to slow down its fall. And that's what's happened. It's been more of a slow bleed as opposed to just a collapse like we saw earlier. So that trade, which was a bullish TLT trade, which probably has no business being profitable right now, is actually nicely profitable. So that is a key benefit of selecting the right types of option strategy out there as well. You could be wrong on the direction, but if you make the right options decision, you can still be profitable as a trader. So maybe it's better to be lucky than good in that sense, but I am pleasantly surprised that that trade's actually working out pretty nicely for us. Obviously, if TNX continues to ratchet higher day after day relentlessly, then my tune might change around that. But there is that possibility, since we're back to where we were 3 months ago on TNX, that maybe there's going to be a little bit of a topping out on yields at around these levels. Maybe that'll give an opportunity for bonds to catch a little bit of a bid price-wise. The other thing I would like to point out is that high yield bonds suffered more than these other bond categories, foreign bonds and long-term treasuries. And remember, that's a sign of risk appetite, and it's not a good sign in this case. It's a negative risk appetite assessment. It's basically saying that the riskiest areas of the bond market, the junk bonds, are selling off more than the government bonds. It's basically a fleeing for the hills type of a moment. People are trying to get out of risk assets. So that's another one of those things that goes in the camp of these are more bearish market conditions that we find ourselves in. The other thing is that the US dollar remains somewhat strong. Now, this is a rare time where the intermediate reading was exactly the same day over day, which is why the background color is white. We don't see that very much. It has to happen when the intermediate number is exactly the same as the prior day. So that's why it's so rare. But as you just kind of eyeball the chart, I think we can all agree this is a strong chart, right? This is a bullish trend that has been established here for the US dollar. And out here on the top rung, notice that we've got bearish conditions across the board, whether you're looking at common stocks in the US, preferred stocks in the US, or foreign stocks across the board. It's just been, pretty relentless selling here for, this most recent time period, and that's created strongly bearish market postures according to the intermediate line. Real quick here now on the sector 12 grid. We do have one green chart left, and that happens to be energy, but who knows how long that lasts. Energy is quite cyclical. And it's possible that if the market starts spiraling lower, that it could very well drag energy with it. So I guess we should be thankful we got one green chart in this environment, but obviously these are precarious times right here where we've got chart after chart breaking down. We do have consumer staples with an oversold cluster signal as of today. We also have technology with an oversold cluster signal as of today. So maybe we have the potential for some snapbacks in those areas, but we also have broken trends, right? So any snapback should be treated with hesitation and caution, meaning that you should assume that it'll eventually roll over and the bearish trends will continue, even if you get a snapback rally in just a few days. In terms of today's worst performing sector, it was probably technology. Actually, I take that back. It was actually energy, barely, but energy was down 2.58%. Technology was down 2.3%. So, and then utilities actually is in that part of the conversation as well. They were down 2.49%. Real estate was also down over 2%. And remember, those were the four sectors that I specifically pointed out on the heat map at the beginning of tonight's presentation as being the most consistently red on the heat map. So no surprise that those were all the sectors that were down over 2% here today. We did have healthcare and financials closing in the green. And again, given what we saw with the likes of JP Morgan and Humana, then that makes sense that we did have an opportunity to close in the green there. Healthcare was up 0.56%, where Humana is involved, and then JP Morgan, of course, involved in financials, where it was up 0.33%. Let's talk about our trade application example. And in this example, I wanted to do a sold put trade application because the market was down over 1% today. So what I did is I went to the Dividend Aristocrat list and I looked at which stocks were down the most this week. I was curious which of them had been kicked the hardest this week. And one of them that showed up was a little bit surprising to me, which was T. Rowe Price. It was the third worst performing aristocrat this week, behind only Nucor Steel and West Pharma. And so that was the one that I ended up selecting for our trade application. I'm going to pull up chart 2A to kind of give you a lay of the land when it comes to T. Rowe Price as a DGI type of an investment. An aristocrat, for those of you that aren't familiar, means that the company belongs to the S&P 500 and has raised its dividends for at least 25 years in a row or more. Now, the way that you read this dividend stair-step chart is if the stock is trading in the blue zone, then that means that the current yield is attractive compared to its typical high yield throughout the last decade. So for T. Rowe Price specifically, its average high yield is 3.03%. You can see that it's currently trading at 4.28%, so tremendously higher yield here in real time. T. Rowe Price is a little bit more aligned with growth stocks, which is why you're finding it suffering a lot more this year than it had in recent years. But what I ask myself when I'm thinking about put sales, or at least one of the questions I'm asking myself is the dividend well protected? Because it does you no good to have a 4% dividend yield if the company is just going to come out and cut it a month from right now, right? So you need to have a lot of good coverage from that perspective. You'll notice that the payout ratio on T. Rowe Price is 44%. So that's quite attractive, right? 100% would be bad and anything below it is better. 44% means that less than half of the company's current profits are being paid out as dividends. Now, as I've shared with my students countless times, remember that's a static number. That's a number that is, just right here, right now. But, businesses change. And one thing about T. Rowe Price and the other asset management companies is they deserve to go down when the stock market goes down because they make their money on account balances as mutual fund companies and ETF companies and what have you, right? If stock market and bond market is high, they make more profits because they earn more fees. If the stock market and the bond market is low, they earn less profits because they make money from fees. So it's directly associated with the stock market. Sometimes you hear the phrase that, stocks are like babies being thrown out with the bathwater. Many good companies are being thrown away just simply because the stock market's in a bad mood. I don't really categorize T. Rowe Price that way because they kind of deserve to go down when the stock market is down. It's just a matter of how much do they deserve to go down. You'll see that they are currently 50% below their high. They plotted a high of $224 in 2021. That was just last year, about a year ago exactly from where we're at right now. And in 1 year's time, they are down 50%, currently closing at 112. So 112 is half of 224. That is quite astonishing. Now, one thing that I always like to bring up when we talk about T. Rowe Price is that it is somewhat unique in the world of dividend aristocrats because it is the only debt-free dividend aristocrat. There's about 65 aristocrats out there. This is the only one that is completely debt-free from a long-term debt perspective. And so that plays a role as well. I acknowledge that the business model will struggle when the stock market and the bond market struggle. But I also acknowledge that they've got plenty of firepower because they currently have zero debt. So if they needed to borrow money for, a few quarters or even a year to pay that dividend, they could definitely get away with it. Whereas so many other companies are highly leveraged. Many of them, are concerningly so leveraged. This one has zero debt. And I think that puts them in a little bit more of a bullish conversation than some of their peers because it gives them a little bit more of a lifeline to continue to raise that dividend moving forward. So what I did was I sold I think it was the 95 put in the month of October. And so that expires in about 30 or 40 days from right now. And I chose that particular strike because that's the 1% return on risk. So I think I got $1 for selling the 95 put. So $100 came into the paper money account today. And in exchange, I am now on the hook for buying 100 shares of this at $95 per share. You'll notice that $95 on this chart is approximately right here that I'm circling. And you'll notice that is well below the lows that it plotted here in June where the market was bottoming. So it would have to eclipse that low and then some in order to threaten that particular area. And for some of you that actually want to own T. Rowe Price as a dividend investment for the long term, $95 is probably an interesting level to consider that. And I say that because that would make the dividend yield at the time even more dramatic than it already is at 4.28%. Remember, they're paying out $1.20 per quarter in dividends. You take $1.20 times 4 to annualize that, and that's $4.80 that gets paid out on a yearly basis. They've already paid out 3 of them, so they'll probably increase the dividend again in January, just like they have for the last 36 years. But even without thinking about that possibility and just sticking with the current annualized dividend, if we divided that by $94, and the reason I'm using 94 instead of 95 is because I got $1 of credit. So I'm shaving $1 off of the strike price, and my true break even in that trade is $94 per share. So $4.80 divided by $94 means that if I were forced to take ownership of T. Rowe Price based upon this sold put idea, my yield would be 5.1%. That is a lot higher than the already high 4.28%. So whether that's going to be a winning trade or not, I have no idea. Obviously, I cannot make any sort of guarantees around that. All I can say is that a debt-free company that's raised its dividends for 36 years in a row would be a reasonably enticing candidate for a long-term portfolio if it was yielding 5.1%, well above the current treasury yields that I was mentioning before that are high in their own right. Okay, so that's what I had for you here tonight, a sold put idea on T. Rowe Price to take advantage of rising volatility and the big market sell-off that we've had this week. If you enjoyed that conversation or the other things that I discussed with the dot-com bubble or the VIX conversation or the conversation about the rally after the clusters and then the gap down on the rejection day and all that good stuff we talked about tonight, I ask one simple request out of you. just click like for me there on Twitter. As long as you can do that and 100 of you are willing to take the 5 seconds out of your day, I'll be happy to give you another full-length video on Tuesday when this video will next be released. Remember, David will be gone for the next few days, so the next time you'll hear from us is likely going to be on Tuesday, and whether it's a 15-minute version or closer to an hour like this one, we'll leave that up to you guys and see whether you're willing to support us there on Twitter. We do appreciate those of you that are willing to take that effort for us. Thank you so much for that. I hope you guys have an enjoyable weekend. Again, babysit your positions tomorrow. It's options expiration and markets have been hairy. So make sure you don't just go walk for a half a day away from your computer assuming everything is going to settle the way that you need it to. You might have to be sitting at your computer making sure things don't go haywire, especially after learning that FedEx is nosediving the market here after hours tonight. Okay, so with that, I want to wish you all the best of success with your trades and your investments. Goodbye for now.